Good morning and welcome to the IP Group PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Greg Smith. Good morning to you.
Thank you very much, Alex. Good morning and welcome everyone to IP Group's 2023 half-year results presentation. So this is the third time now this year that we're presenting an update through the Investor Meet Company platform, and I'll come on to cover this at the end of the presentation, but this is part of our continued investment in an active year-round program of IR activities. We're trying to offer greater transparency and enable a deeper understanding of the group, our focus sectors and key portfolio companies. So in time-honoured fashion, the disclaimer, the presentation will be up on the IR section of our website shortly after the end of this presentation. Just please note the usual disclaimers about the nature of this update and any forward-looking statements that might be contained within that rather dense text. So today's presentation will cover a short overview from me, an update on how we continue to successfully deliver against the strategy that I set out last year. And this will mainly focus on progress in our three investment areas, and I'll give some specific updates on three of the companies that I highlighted in our full year results presentation as sort of value drivers, things, inflection points to watch for the coming year or two. Dave Baines, our CFOO, who I'm joined by, will then briefly run through the actual financial results for the 6 months. Then I'll wrap up with a summary and outlook, and then on to questions. And for that part of the presentation, we'll also be joined by Mark Riley, who is our managing partner of technology, and Sam Williams, the managing partner of life sciences. So the tough technical questions, I will get Dave to direct to them. So as Alex said, please make sure you post your questions in the Q&A section. As always, we will endeavour to cover all of them. We'll try and group them to keep things sharp. So in terms of the overview for today, I mean, the things that you should take away are that our portfolio companies are making really strong progress. They are well funded and the group continues to be financially strong. I want to start by covering a little bit of market context. So I think firstly, it's fair to say that there have continued to be some headwinds in the first half. I spoke about these at the time of our full year results presentation, and to give a little bit of an update on that. So I think that the general global picture is that the first 2 quarters of 2023 have continued to be at a lower level of sort of total value and number of VC fundraisers compared to 2021. It's definitely worth saying there are signs that this is stabilizing. It's around now the same sort of level of activity for about the past 4 quarters, and that's at around the same sort of level as 2018, 2019. So maybe some signs of stabilization. And there's been little change in early VC round valuations over the past sort of 5 years. If anything, maybe a few $1 million higher. Later stage valuations, however, are definitely back to sort of 2018 levels in the US. And there's a sort of a lower level of reduction in Europe. Worth reminding, and we put an RNS about this at the time, there was some disruption to the ecosystem from the failure of SVB, but we were able to deal with that from a position of financial strength. And exit activity continues to be at multi-year lows. One bright spot, though, is that biotech M&A in Q1 was up 5x at about $50 billion around the world. So that's sort of definitely one of the bright points. So the environment's been a bit challenging, but there do definitely remain significant longer-term tailwinds, particularly for our focus areas. On the regenerative future side, the numbers are large, whatever you look at, but they're specifically for one of the companies I'm going to cover later. The Hydrogen Council noted that around 240 billion of large-scale hydrogen projects out to 2030 have now been announced. And indeed, this needs to triple to more like 700 billion to reach those net zero targets. On the tech-enriched future side, last year, of course, it was AR, VR, XR, and markets.
Greg, we have lost your audio, so please, ladies and gentlemen, just Bear with me as I try to reconnect. Ladies and gentlemen, just please, oh, there you go. David, can you hear us well? Greg, can you hear us?
Just bear with me 1 second, just while I bring Greg and David. Just let me take control there of 1 second. Let me just come into your machine there. Okay, can you hear us there, David?
I've got you. We've got you both.
Lovely. Thank you.
Can you hear us? Okay, great.
Yeah, carry on. Very good. So I don't know how far we got through that, but in essence, I was talking about some very large markets that are being addressed by our sectors. I was finishing on sort of genomics and precision medicine, again, sort of 100 billion, 250 billion. I mean, really, these are all big numbers, but I think the point of them is just to illustrate that the scale of opportunity to be addressed isn't the issue for our portfolio companies. Now, closer to home, the last point there, on our full year results call, I highlighted this thing around the sort of the UK science superpower agenda. And I think importantly for our sector particularly, there continues to be quite a lot of momentum around making the UK the best place for great companies to start, to grow, to scale and to stay. And that's of course, while also ensuring that policyholders, pensioners and savers have got enough money for life events and for old age. And I often talk, whenever asked about this, about the 3 C's of having sort of capital, conditions and consumers being needed to achieve this. And on the capital front, whether people have seen this or not, but I thought it was very interesting. A couple of reports recently have talked about how the share of UK listed companies owned by UK pension funds and insurance companies has fallen from about 40% down to about 4% since 2000. And crucially, just 1% of the nearly 5 trillion in pensions and insurance assets is invested in unlisted UK companies. Now, we've been doing a lot of work engaging with various parties on this, and the Mansion House reforms included quite a lot of continued positive direction on this front, including the pensions compacts between many of the UK's leading DC pension managers. So, of course, worth pointing out that IP Group is already backed by a number of UK pension funds and managers, including Railpen, Phoenix, Schroders, M&G, Border to Coast, and we've also got Telstra and Host Plus in Australia. So I think it's really important. I think the opportunity here is for IP Group to be a core holding for more such funds, as well as offering the potential to access significant private capital. And as a reminder, we currently manage around 700 million of third-party private capital. So we focus a lot of effort here. And why do we consider the group to be particularly well positioned? Well, this slide, which I'm afraid it definitely breaks the usual rules of one message per slide. So I'll do it quickly, but it sets out why we think that this is the case. And the simple investment case is that IP Group offers liquid, diversified exposure to high growth innovation companies across some of the most important investment themes of the coming decades: life sciences, clean tech and deep tech. We're offering investments making a genuine impact. And specifically, we're the most active investor, the most active UK investor in this deep tech space, and we have a highly experienced team in each of those focus sectors. We've got extensive access to science and innovation across really much of the English-speaking world. In terms of track record, we've created 3 unicorns today. That's Nanopore, Ceres and Hinge Health. And we've delivered around a 10% return on NAV per share since IPO, once you account for dividends. And impact really is at our core. Our portfolio is very aligned with the UN SDGs, so we're quite attractive to that growing pool of ESG and impact investors, including the likes of Lion Trust, who are a major shareholder. And we're growing scale. We're about 2 billion of assets now. That's about 1.3 billion on the balance sheet and about 0.7 of third-party managed funds on which we earn fees. And I think from a shareholder value point of view, which of course remains front of mind, we've also continued to support capital returns with a total now of 70 million of cash returns since introducing our new approach to supplementing cash returns in 2021. So we really do continue to pursue our mission from a position of strength. So with that overview as sort of context, the financial picture for the first half is as follows. And I think firstly and most importantly, the underlying business and the portfolio has made strong progress
and that's been well evidenced by a total of 300 million capital raised by the portfolio, of which we invested about 60 million. This actually compares pretty favourably to 350 million raised in the first half of 2022, particularly when you consider my comments earlier on the general VC funding environment. And as you'll see in the release, the quality of our co-investors remains very strong, and I'll talk about three particular companies shortly. The second is that the loss of the half was around 55 million, about 5%. So NAV at 30th of June is about 127p. Now, the quoted portfolio, mainly Oxford Nanopore, is actually up by about 45 million in July. So our NAV is a little over 130p a share at today's date, or the date of the announcement. And then finally, the group's maintained its financial strength during the period. Gross cash has actually increased versus the 31st of December a little bit, and that's partly as a result of 32 million of cash realizations, and then the second tranche of the debt that we placed last year, given the challenging investment environment. So we've also tried to give quite a lot more disclosure in our half-year results around the funding needs of the underlying portfolio, and Dave is going to cover that in his section shortly. And then finally, we've continued that approach of dedicating a proportion of cash realizations to supporting capital returns, and we're again declaring an interim dividend, which will be a little over half a pence a share. So that's the context and the summary of the results. I now want to move on to talk about progress, and you will hopefully remember from the full year results, we are fully aligned and engaged behind delivering our purpose to accelerate the impact of science for a better future. And we have a strategy to deliver this, and a key pillar is around accelerating value creation. And the way that we do this is through investment focus and approach. I mean, our business model is actually very simple. We're aiming to be the leading value add backer of impactful early stage innovation, and we target opportunities, as you remember, at that sort of intersection of societal need, commercial opportunity, and IP Group strengths. We genuinely back breakthrough innovation, and we use the technical acumen and the experience of our teams to assess value and risk reward of that innovation better than others. And that leads us to those three thematic focus areas, and I described back in March that each has got quite a distinct and complementary investment profile over the next sort of 1 to 2 years. So let's just take each of those in turn and give a quick update. So on the healthier future side, having sort of consolidated down the portfolio into about 20 core holdings, there are now 12 companies that are targeting key clinical milestones. They're shown here by stage. You can see a couple of them, there's 14 on the slide, a couple of them are preclinical, but there's 12 that are in the clinic. And those 12 add up to about 25 pence a share, or about 40% of our market cap. And 7 of those read out in the next 12 months. You might remember at the full year results, I said 8. And the good news is that Mission read out positively in H1, so there's another 7 to come. And the team is very much focusing resource and capital on the delivery of these milestones and driving the commercial value that will arise from successful outcomes, with a lower focus on new opportunities. I don't show it here, but as a reminder, on the healthcare side, there's a further 22 pence per share in Hinge Health and Oxford Nanopore, which again is about a third of our market cap, and they are targeting and delivering significant revenue growth. On the tech and rich side, this slide here is showing the deep tech portfolio by sort of focus area on the left, and current level of revenues is actually the last full year revenues, and that's because the value drivers for these types of businesses are generally, one of the key KPIs is revenue and revenue growth. And if you take 3 of our most valuable deep tech companies, that's Featurespace, Garrison and Taya, that adds up to about 10 pence per share of NAV, about 15-17% of our market cap, and they are targeting value accretion through continued double-digit revenue growth, and they make good progress in the first half towards that. There's obviously a number of promising early companies there who are looking to grow revenues, and many of those, which you'll see in the release, raised significant funding rounds, including, worth noting, Quantum Motion Technologies. 42 million funding round was the largest ever single investment into a quantum computing startup in the UK. So really good progress there. And then the third, regenerative future, whether we talk about sustainable investing, climate tech, clean tech, or otherwise. Last year, we made a deliberate choice to build on our successful track record and launch Kiko Ventures, a team, a brand, a portfolio focused entirely on this area. And we believe we have the leading team in Europe for this. So current portfolio really is focused on 3 holdings, First Light Fusion, Oxa and Isata. And again, that's around 20 pence NAV per share, about a third of our market cap. First Light has seen good interest, but yet to complete its funding round. And you remember, hopefully, that we heard from CEO Gavin Jackson at the full year results following their 140 million fundraise at the turn of the year. And I'll give a quick update on Isata. I did say at that time that the focus for 2023 is adding new companies to the portfolio. The team continues to have a strong pipeline on that front, but we continue to be judicious and measured, and we haven't made any sort of brand new investments in the first half. But you can see lots of activity and some funding rounds, including for OxCCU, which we mentioned in the results as well, which is a really exciting e-fuel business. So that's a summary of those sort of complementary and distinct value drivers for each of the 3 investment areas. I'm now going to give you a quick update on inflection points. So this was the slide, again, hopefully you remember, that I concluded the full year results presentation with back in March. And it shows those focus areas and value drivers, but it also shows a handful of companies that we were sort of noting may well be ones to watch for the next sort of year or 2. So I just want to evidence progress in the 3 thematics through updates on one of each of those companies. So I'll start in the life sciences space and the healthier future space with Istesso. So Istesso is one of our top 3 most valuable holdings, and I genuinely believe one which has the opportunity to deliver huge real-world impact and substantial financial returns. So Istesso's vision is sort of to deliver this paradigm shift in healthcare, moving from disease modification to disease resolution, or perhaps in layman's terms, moving from simply treating symptoms to starting to cure disease. And the challenge, or perhaps the opportunity here, is that conventional disease modifying medicines, they can slow the pathologic or the symptoms or the sort of functional decline, but they can't reverse disease, and in some cases may even suppress repair. And another example that many of you will probably be aware of from COVID times was those people who are on immunosuppressants for dealing with such diseases can become immunocompromised. And so there are lots of sort of existing issues with the current treatment paradigm. Now, Istesso's approach really has the opportunity to go beyond this conventional approach of disease modification and actually move towards rebuilding damaged tissue. So this could enable patients to not only reduce symptoms, but also reverse their decline, resolve disease and regain lost function. And this could fundamentally change the way that patients experience disease. So you'll hopefully remember that Istesso's lead compound, MBS 2320, is currently in a phase 2B trial for rheumatoid arthritis. And the market opportunity in this space is huge. Estimates vary. We have it on the slide at about 25 billion, and it includes some of the biggest selling drugs in the world, Humira and Enbrel. RA affects a vast number of people, and prevalent cases are estimated at about 25, 27 million around the world. So it's a very, very significant area. Good news, the phase 2B continues to recruit according to expectations and very much on schedule for a readout in the first half of the next year. And then the sort of second point I'll make is at the time of the full year results, I mentioned that the FDA had granted Istesso orphan drug status and fast track status for another debilitating disease, that of lung fibrosis, or what's called idiopathic pulmonary fibrosis, or IPF. And you can get an idea of how it feels to have the symptoms of IPF by taking half breaths for about 30 seconds or so. And I won't get you all to do it now, but you start to experience a physical reaction and almost a panic, and you really want to draw in breath. And essentially, this is what sufferers experience all the time as lung function declines. I mean, amazingly, in the UK, IPF accounts for 1% of all deaths each year. And there are, again, estimated to be about 1 million prevalent cases worldwide. So the market opportunity is also very big, and we have it at about 4 billion currently. So in this context, and given the market opportunity and our strategy to focus more of our capital on fewer significant opportunities, in the period we've invested 15 million into Istesso with a commitment of a further 10 in 2024, which fully funds both of those trials. The IPF will be a phase 2. It's going to be commencing shortly this year. We'll announce when it starts, and we're targeting a readout in late 2024. And we believe this will significantly increase the upside value case for the company, with the downside limited to that incremental investment amount. As a reminder, we own over half of Istesso. We've invested about 40 odd million. We currently value that at 113, 114, as you can see on the slide. And just as a reminder of the sort of the market context, I mentioned earlier, one of the bright spots so far was this sort of 5x pickup in biotech M&A in Q1. This included an acquisition of a business called Nimbus by Takeda, which is a 4 billion acquisition up front with a couple of billion of milestones. Nimbus is developing a JAK inhibitor, I think called a TYK2 inhibitor, for the autoimmune condition psoriasis. And this was a phase 2 company. So it's not direct read across, but it's at least indicative of strong interest in this general space. So great progress on Istesso, and fully funded to deliver 2 phase 2 trials next year. So key value inflection points for the group. I'll now shift tack a little bit and talk about a company called Garrison. Many of you might well be less aware of this one. It's been sort of quietly delivering strong revenue growth though, and so I wanted to highlight their progress as one of those value drivers to watch. And to frame it, the problem that Garrison solves is one that I imagine pretty much everyone on this call will be able to relate to. It's primarily mitigating against sort of ransomware and phishing attacks. People will probably be aware that the average cost of a data breach in 2023, according to IBM, was $4.5 million. So it's a very significant market. There are various ways to measure it, but we certainly have the TAM at sort of multi-billions of dollars, certainly more than large enough to be no constraint on Garrison's growth. And what Garrison have done is they have developed and are selling a new security product, and it's far more effective than the current solutions. Indeed, it increases the success rate of preventing malware attacks from about 30% up to close to 100%. And the solution is sort of quite simple in concept, but very difficult to deliver technically. I mean, essentially, they have a hardware appliance, and it sits on the edge of a corporate network. And when employees browse the internet, the content sort of goes through the appliance, and essentially you use video technology to show the employee the content on the internet without any direct connection. So it's not possible for malware and spyware, etc., to get into your corporate network. Now, until reasonably recently, Garrison's solution was on premise, and so key customers were sort of UK and other governments, and they wanted ultra secure browsing. And they also had a number of blue chip customers such as Lloyds Banking Group, Fujitsu, Vodafone Business. But in the last year or so, Garrison has now launched a cloud product, Ultra, and that's seeing strong early traction with customers. So during the first half, they have a year end to March. So during the first half this year, Garrison hit annual revenue of 19.5 million, and that's 64% year-on-year growth over the last 4 years. So it's growing very strongly into a very significant market. The company completed an oversubscribed funding round during the half, bringing in L&G Ventures, Legal & General Ventures, as well as BPC. We invested about 4 million in that round, and we own just under a quarter of the company. So the plan here is to support that business through continued revenue growth, and it will accrue significant value as a result of doing so. So that's an example of progress in the tech and rich future side. And then on Isata, I mean, this is genuinely one of the most exciting new companies to emerge from our sort of university sourcing over the last couple of years. It's undoubtedly the case. And those who joined the half-year results this time last year will have seen an overview by CEO Paul Barrett, and that followed the completion of the funding round that they did, the 42 million Series A back in July last year. And that's available on the IR section of our website if you would like to go back and have a look at it. And the vision of this business is to completely redefine the economics of green hydrogen. And it's a vast market opportunity. I mentioned those numbers from the Hydrogen Council and McKinsey earlier, that's sort of 700 billion to 2030. I mean, overall, green hydrogen is expected to contribute about 20% of the total abatement required to 2050. And this is particularly relevant for the hard-to-abate sectors such as steel, and chemicals, and maybe heavy transport. And electrolyzers are the key technology for producing this green hydrogen. And the real challenge at the moment is that current electrolyzers they're complex, they're expensive, and there's only really been incremental operating efficiency improvement over the last 50 years. Now, Paul and team aim to address this huge opportunity through a completely novel approach to hydrogen electrolysis. It's called capillary-fed electrolysis. They published in Nature with our support and have demonstrated 95% system efficiency compared to the current best of around 70 to 75% efficiency. And so probably, perhaps unsurprisingly, given that sort of market opportunity and the huge differentiation, Isata has seen unprecedented commercial interest for potential customers, like of a scale that we haven't seen in early companies like this before, like multi-gigawatt scale orders, of course, providing the technology can be delivered at scale. So over the last sort of 12 months since that funding round, they have done significant work on system development. The manufacturing is highly scalable. It's got abundant raw materials, and we plan to do large-scale manufacturing through contract manufacturing. And the company, as you'll see on the slide there, is also attracting really world-class talent. They recently announced the former Chief Commercial Officer of BHP as their chairperson. They've got Australia's former chief scientist as the chair of their advisory board, and they're attracting talent from the likes of sort of Apple and Tesla into the engineering team. So really world-class team. And in terms of progress, they hit a really challenging technical milestone in the period. Now, full details of which they're going to announce shortly, so I won't steal their thunder, but it was essentially connected to replicating the performance of that single cell at a greater scale. And I will say this usually takes electrochemistry companies sort of several years. So for the team to do it in such a short period of time with relatively limited resources, a really remarkable achievement. Not only that, they announced around 10 million of grants from the Australian and German governments. And so while the Series A funds the company to sort of mid-2024, we do expect the exceptional progress to trigger an earlier Series B, and there's been a bit of press speculation on that front. And we own about half of the company, and given the significant progress, we took a small uplift of £8 million to the total value of our holding, which is up to 31 million. We've invested about 13 million into the company. So really strong progress across those some of those companies that I highlighted back in March. And with that, I will hand on to Dave for a summary of the financial results.
Excellent. Thank you, Greg. Hello, everybody. Yes, I'm David Baines. I'll just briefly take you through the financial numbers. As Greg's already told you, we've strong cash position, about £250 million of gross cash. That's actually more than we had at the year end, actually more than we had at this time last year. So we've managed to achieve that really through two ways. We had the debt facility, we'll talk about a bit, that's allowed us to draw down £120 million of debt. And we've also had the exits as planned, about £33 million worth of exits coming out. Again, as Greg's already said, we had a loss of about 55 million in the period, and that's why you see the NAV has weakened slightly from sort of about £1.32, 33 to about £1.26, 27 per share. But again, also, as Greg has pointed out, a lot of that was due to Nanopore, and actually Nanopore reverted in July, just after the results, and actually has made a profit of 42 million in the last month. So actually, as we stand now, much of that actual loss has been eliminated. We're in a strong financial position. That's why we're continuing with our dividend, slightly up from last year, this time last year, at 0.51 pence. So diving down into that 55 million loss, what was it? Well, it was basically £44 million loss in the portfolio and about 10.5 million of overheads. And if you look at that, again, point already made, but actually, about 30 million of that loss came from the credit portfolio. Most of that was Nanopore, 28 million of it. Not so obvious as the element of the foreign exchange. Some of it is a foreign exchange loss you've got there, about 11 million quid. Now that's happened because the pound strengthened. And ironically, of course, as the pound strengthens, it means you're getting less for some of our overseas denominated assets. So it meant the US platform in that portfolio and the Australian platform in its portfolio have actually sustained a foreign exchange loss when you convert them back into British pounds. The other small elements, small reduction in the LPs, actually the private portfolio, small profit in the period. And that was because we've taken a small uplift on Isata. And that's also reflected on the other side. Nothing particularly unique about the performance of any of the divisions, but actually Cleantech did achieve a small uplift in the period because of that Isata point. When we look at the net assets in the balance sheet, as you would expect, with that small loss of 55 million, relatively small compared with NAV, that is, the NAV hasn't moved by much. It's reduced by 61 million, which is the loss, plus the element of the dividend that we've paid out in the first half of the year. Perhaps that slide there on the right is a little bit more interesting. That £1.26 per share, when you look at what makes that up, 10p is net cash, and then you get just the 5 assets we pretty much touched on today. You get to 62 pence. Well, we started trading at 60p this morning. I think we're about 58. So the whole of the market cap is accounted for by cash and those top 5 assets. Everything else in our portfolio, and that includes the whole of the US platform, the whole of the Australian platform, and another 88 companies, are actually currently not factored in at all, that 71.5 pence. No enormous change in portfolio composition and concentration from year end. You wouldn't really expect it to be. Nanopore was down a little bit. It was about 16% at year end. That's because it's down a small amount. You pretty much, when you put Nanopore and life sciences together, about half the portfolio in life science type opportunities. The only other thing to note, and as we said at the year end, Cleantech beginning to grow. It was 19% at the year end. It's now 21%. Beginning to grow. I think we expect to see that continuing, that pattern. And on the right there, as before, at the year end, about 74% of value is concentrated in top 20 assets. It's now 70%. That just reflects a slight reduction in Nanopore again. But it shows that actually, despite having a very large portfolio, which is in the nature of the model, actually a lot of the value is concentrated in a small number of assets. I always say at this stage that cash flows kind of tell the story of the year. And I think that's the same as always. We know that cash is slightly up on the period, and that's really made of an investment of about 60 million. Now, to give you a guide, we'll do a similar amount, slightly less in the second half. As a guide, 100 to 110 million probably invested in the year, slightly up from last year, which was 93 million. And that's been entirely funded by obviously drawing down the second tranche of that debt of 60 million. That's a way of looking at it. And then the realizations of 31 million paid for all of the dividend. It paid for that sort of 10.5 million pounds worth of net costs and any working capital. That's pretty much how the cash flows worked out. Perhaps worth just slightly making the point that those gross costs are actually 12.1 million. They're pretty much exactly the same period on period. So costs have remained pretty consistent over the two periods. I won't go on about this slide further. We know this. We know that the cash is strong. We know that if you include the liquidity in Nanopore, actually got about 450 million of liquidity. And we know cash proceeds are on target. And we have this well-funded debt position. What people know less about, I think, is how well the portfolio is funded. It's interesting when you look at that. So if you look at just the companies we hold above £4 million, that actually makes slightly over 90% of the portfolio by value. Well, a third of that is funded to profit. Now, that doesn't mean they won't raise money. They might IPO, for example, and raise money. They don't actually have to. They are funded to profit, a third of it. And perhaps slightly more remarkably, only 16% of our portfolio needs to raise money over the next year. That's between now and the end of the next interim, so technically 11 months. But over the next year, only 16%. And it's not really until the second half of 24 you start getting a significant larger number, and then the rest of 22, 24% until 2025 and beyond. So I think that shows that not only is Topco strong, but the portfolio companies are strong. And hopefully that the kind of the turn in the tech market that we saw really after the end of 21, that would be into its third year before we start trying to fund some of those companies. One other point I want to make is a point that we've made many a time before, but no harm in repeating ourselves. We consider the portfolio, despite its significant discount on the share price side, is very fairly valued. The auditors always say we are mildly cautious in our valuations, and they did actually do a deep dive seminar on valuations. I think a lot of you participated in. Thank you for that. And many of the message is the same. About 16% of our portfolio is valued mark to market, and then you've got 35% on a funding round without adjustment, and 23% on a funding round where you've made some slight adjustment up or down. But it means 75% of the portfolio is either publicly marked or on a relatively recent funding valuation. And the rest of the portfolio, even those valued on revenue multiples, is a very fair way of valuing companies and discounted cash flows. So actually, we have a well and fairly valued portfolio. And to endorse that fairly valued point, it's probably worth just having a quick look at what we've seen out in the market in terms of how our companies have performed. if our companies were being carried at too high a value on the private side, you'd see it when the valuations, when they did fundraisings, because you'd see you weren't able to sustain the prices. So for the half year last year, this time last year, there'd been 13 fundraisings, and you can see about half of them were actually up, about 40% were flat, a small amount down. In the second half of last year, on 16 fundraisings, 75% were up, with a relatively small amount flatter down, and we've seen that again. So here you are again, you've got about 70% plus are actually still being up, a relatively small number flatter down. It's only about 2 companies out of 14 are actually down. So that seems to support our premise. Interesting, because of our position as kind of the leaders in the UK in this space, we get very good insight because Park Walk's business as well, and they've made 9 investments in the period, 6 up, 3 flat, none down. So I think we feel pretty comfortable with our valuations in summary. So to my last slide, and then I'll summarise. This is probably the last time I'll talk to the debt. We negotiated this last year. We've now drawn it all down. We've drawn down the second tranche. The point is probably worth making. We did that at a good time in the cycle. We've got it fixed at 5.25% interest. At the moment, the average we're getting on our funds deposited, some of which have been deposited for a while, is 5.55. So we're actually getting more than we're paying. And on the new deposits we're making, we're getting 6.1. So obviously that's worked very well for us in sort of self-funding debt. So in very quick summary, what have I said? So we know what we've been. Number 1, we're well funded. 2, our portfolio is well funded. And 3, we believe our portfolio is fairly valued. I'll hand back to Greg.
Thanks, Dave. So I'll quickly summarise before we get on to questions. So firstly, a reminder of the investment case. I mean, the simple investment case, we offer liquid, diversified exposure to high growth innovation companies across some of the most important investing themes over the coming decades. So that's life sciences, clean tech and deep tech. And those are investments making a genuine impact. And then I think we're particularly well positioned for this sort of science superpower and long-term capital agenda. In terms of the key points from the half years, Dave said, NAV was down a little bit to the half year, but it's broadly flat at today's date at around 130p. Our portfolio companies are making strong progress. As Dave just described, they're very well funded and the group continues to be financially strong. And I think maintaining that sustainable position for IP Group is something that we consider is particularly important. We don't want to go back to the days of raising capital every 2 or 3 years. And so we have taken significant steps to ensure that we are self-funding in that regard. And then a quick reminder of the key value inflection points and hopefully recapping a little bit on what I said earlier. So you've got about 25p or about 40% of NAV in 40% of market cap in 12 clinical assets with 7 readouts in the next 18 months. And there's about a third of our market cap in Nanopore and Hinge Health that are both growing very healthily at double-digit revenues. There's about 10p of NAV in 3 companies that are delivering double-digit revenue growth in the deep tech space. And then there's a further 20p in First Light, Oxa and Isata. So looking forward, we believe that supports the fact that sort of organically the group is positioned for a really quite transformative period over the next 12 to 18 months. So with that, I thank you all very much for your attention, and we will now turn to questions. And Dave,
excellent.
Dave will compare. There's a few flicking through the questions. There's a few detailed ones that people might like, things like value of specific companies. I might suggest that we just reply to those and to the individuals in person.
Online, yeah.
We can do it through the platform. Not that nothing to hide sort of thing, but
happy to be guided. Yeah. It sounds very sensible. Yes, so we'll have a go. I have to say, good timing, well done. We aimed for 40 minutes, we're at 39, even with that slight glitch. Sorry about that. I'm sure my computer will get the blame. So the very first question, at the annual results in March, it was stated that a core objective of the board was to reduce the NAV discount gap to the share price, which at the time stood at 59%. It's not much different now. Can you please advise what steps have been taken to reduce the NAV discount gap, and whether you believe you've delivered upon this objective as of today? I'll hand that to you, Greg. It's a tricky question for that, right?
Yeah, no. Look, this clearly is the challenge to the business at the moment. The portfolio is going really well. We've put ourselves in a sustainable financial position, and currently we have a significant discount to NAV. So I included a comment on the steps that we've taken in the first half, or in the sort of 3-4 months since or 5 months since we announced our full year results. And that objectively, We don't think that we've delivered upon that objective, but we continue to significantly drive the sort of the input activity, should we say. So firstly, we've continued with the approach of supporting supporting our capital growth with some cash realizations, a proportion of our realizations in the period. We've declared an interim dividend. We've significantly increased our IR activities. I'll come on and talk about that. We did a big event at the Science Museum, and we were really sort of delivering sort of thought leadership there around how the UK can support UK and innovation companies, and showcase a number of our businesses, so you can get engaged with and see the excitement around those companies and their potential. We've spent a lot of time engaging with new shareholders and existing shareholders. That includes across Europe, the US. We'll be off to various other destinations, and we've refreshed our brand identity. So they're all relatively small things, and fair to say that objectively we haven't achieved that yet, but we do believe that the best way to deliver that shareholder value over time is to continue growing the NAV per share, and which we will supplement with cash. And if we have a huge realization, then obviously we'll think sensibly about what we do with the money and not hoard cash. So we want to be sustainable but efficient.
Thank you. You're going to remain in the crosshairs for some time. I think most of these questions look like CEO questions to me. Is Stesso now becoming a major holding? It says nearly 20% of data. Oh, of market cap. I see. Yeah, fair point. It is 20% of market cap. Any plans to reduce the shareholding in Stesso? One for you, I think.
Not ahead of the results next year. It's plausible that we might raise a little bit of incremental capital. We know we've fully funded the trials. We could do a bit more with a little bit more cash, but in essence, we put the business in a position to deliver on those two critical milestones, and shareholders will benefit from the risk reward of that, which we think is sort of significantly on the upside. So no immediate plans.
Fair enough. Again for you, I think. Any update on the China fund? There's a small paragraph, but any update above that?
Nothing more specific than what we've said in the results. We haven't closed the China fund, and we continue to look at it.
Again, an area of your expertise, importance of Horizon to UK. Any lobbying by IP Group in that area?
Yeah, I mean, this all falls into the general sort of those three C's I often talk about, the sort of the capital, the conditions, and the consumers. On the condition side, definitely Horizon was one that we significantly lobbied, probably a bit strong, but certainly when we've spoken to a number of the ministers involved, and outlined the importance of this for our sector. I think it offers a significant benefit to the UK to be part of a more international operation, and Horizon looks like the best one of those. The government talks about sort of a credible plan B, so we do continue to push on that front. I mean, it affects fundamental research, and it affects the ability of some of our companies to access both capital and talent. So we certainly have been speaking where we can on that front.
Next one might fall into the category of detailed question. I'm going to give it to you anyway. And is it so difficult to sell the small shareholding 1.8% in Hinge? It's worth about 50 million quid, which would provide good funding for the group. I sense that it is locked in. Question, its value, it's a relatively small stake is what it then says. Basically, it's asking, would you consider selling Hinge?
Well, I mean, it's probably not appropriate to comment on specific stocks, but the point is well made about good funding source. And I think when we've given life science updates before, we have said that that's one that we would consider realization for sure.
Next, more general one, and it's a question that traditionally comes up a lot, so I'll definitely give this to you, Greg. How confident do you feel on the outlook? And more importantly, perhaps, and why not buy shares back in the company, given the very low share price?
Yeah, so this is a discussion that we have a lot with the major shareholders, and we'll be off on a roadshow again over the next sort of couple of weeks, and I'll refresh that view. Our view is that there is more of a premium around being a sustainable business. We generally invest in private companies where it's not, you can't sort of trade in and out of our businesses like you could if you were running a listed investment trust. So we're very confident in the prospects for the future. Buying back shares would have an incremental impact on the NAV per share, and it is obviously attractive, and I think the appropriate thing to do which we've set out, is when we have a significant realisation, a proportion of that is used to support our capital returns, and we maintain a small dividend. But clearly, if we have big success, then we'd use that with to create shareholder value in that way, for sure. As a shareholder, myself, I would completely agree with that approach.
Probably time for me to do a little bit of work, but not much. 60 million invested in the first half. What were the second and third largest investments after Istesso? Well, you're right, we invested 15 million, and as you can see, we've potentially committed up to 25, so that both those clinical trials are fully funded as required for them to be launched. The second one was an investment we made in our US platform, about 6.6 million in the period, and our third was Isata, where we put 4.7, both obviously sensible places to put our money. Next one's a little bit technical. Either me or Greg. Greg, I guess you explain.
Just say to the person who submitted that question, thank you. We do appreciate all the detailed comments. Just to say that the largest 5 or 6 investments and the largest 5 or 6 sources of cash proceeds are disclosed in the release.
Yeah, quite understand. We have to go quite a few pages back to get to that. You may not have got there by 10 o'clock, which we entirely understand. There's quite a lot of in there. Can we explain the voting structure of Istesso, specifically how you have less than 50% of votes with 56.5% shareholding? Shall I have a quick to that one? Yeah, you are right. It's not uncommon in these venture structures to have different classes of share with different rights, quite frankly. Sometimes they have additional preference rights, sometimes classes have different voting rights. In our case, we have about 42.8 voting rights in that company at the moment. And that's just a product of the investments we've made and the agreements we've reached during that period. As with any venture investment, you still have relatively significant influence compared with, let's say, a public company, because there are always restrictions in the shareholder agreement. There are things like what a company can do, such as selling itself, entering new agreements, raising money. So it's probably less pertinent than it might be in other companies. And that's why that happens. 2 questions from you, Odysseus. Right, nice to have you here. I haven't read this one yet, so we'll find out. Quite a strong half in investment funds. Is that more due to unusual high funding needs of your holdings? Is it more opportunistic? In other words, you're using your cash to invest in several attractively valued opportunities. Question number 1. Second, given the delay on the First Light Fusion funding round, have your valuation expectations changed? Are you still confident that First Light Fusion's value in your books allows for a fair value gain post-funding? Shall I have a go on those? I feel a bit like my area. It is quite a strong. Well, actually, what we've done is we've managed our cash very well. It's allowed us to maintain our levels of investment. So from 63 million to 93 million, so probably do 110 this year. So it's allowed us to support a growing portfolio while being sensible about the amount we invest, as I explained earlier during the presentation. So it's an increase in last year, but not too sizable. And it's just, it's allowing us to, in difficult times, expand our portfolio. It's not necessarily because our companies have necessarily needed more. It's more us taking the opportunity to invest in very good companies, I would say. On First Light Fusion, our valuation expectations, I think in this current market, ever since the market turned at the end of 21, the likely value of the next round, we have tempered a little bit. But we still feel very confident that it's likely to raise money well above the values we carry it at. Obviously, if the funding round goes on for too long, we'll have to review that later. That's that. There's another question about, does decision not to buy back own shares reflect sharp fall in net cash in half 1? Not really. Our cash position is strong, which I fully understand the question. As we explained, no, I think Greg's already explained why we haven't really been buying back shares at the moment.
Yeah, I think that was a net cash point. It's just I think it's worth making the point we've got the debt goes out to 27, 28, 29. So we obviously look at net cash and gross cash. Gross cash is the ability to invest, but our forecast for realizations in some of those outer years is clearly intended to maintain that sort of sustainable position for the group.
Okay. Next one, I'm not quite sure we did mention this. You mentioned that investments so far this year have been minimal. I'm not sure they have actually, about 59 million has been quite good. But you were looking to invest in new companies during the second half. Do you notify shareholders via an RNS? And when you have invested, giving details of the reason and potential of such investment? If not, why not?
Yeah. So thanks, Russell. That comment was specific. I was just sort of covering what I'd said the focus was for the Kiko team on the clean tech side, and that's new companies. So the way that the funding for our companies often works is relatively small initial investment, and then we scale the investment in subsequent rounds as the companies hit milestones, or preferably if they're not going to hit those milestones, then we are able to close them relatively early. That's a core part of the model. We tend to not announce individual new investments because of the quantum compared to market cap, etc. But we do try to give details of those. If you have a look at our annual report, we give quite a lot of detail on the investment case for a number of the new businesses that we've made in the year, setting out exactly that, the potential and why we've backed it. There was one in the deep tech portfolio, again, that we've described in the RNS during this period. So we tend not to do an RNS on each individual new investment, just because of the quantum that would be, but we do update at the full year and the half year. So hopefully that helps.
Yeah, I have moved over a few questions, as you say, they're technical or company specific. There's a question about Garrison being close to when is it going to be break even. Mark, are you there? I can't see you. I don't know if you're with us. Are you there? Do you want to talk to Garrison if you're with us? Oh, there you are. Sorry.
I am here, yes. So look, I think we ought not to disclose specifics of recent numbers on behalf of the company. I think that's up for them to release, and they haven't done yet. They have allowed us to talk about their revenue, which, as we said, is close to 20 million this year. Their past year revenues are on Companies House, so that's public information, and their margins and corresponding loss are on Companies House, so you can see the trajectory of that business. But look, it's doing very well. It's moving towards a profitable position, and we're very pleased with that.
Great, thank you for that. Thanks very much. There's a question about what's happened to the valuation of SaltPay. Very little. It's only changed by a very small amount. There's a question about Centessa, what its value was at the end. It's about 12.3 million. There's a question about what's the mix of new investors during recent funding rounds of your portfolio companies? How many of them are VCs compared to non-VCs? Would you like to refer to that, Greg? Sure. I know there's information in the release.
Yeah, there's a bit of it. So again, we try to put information in the release both around specific companies where they release the information, and also the overall mix of the types of investors that are investing in our portfolio companies. So you can, I mean, the general trend that we've seen and that the market has seen more generally is that there's been a bit of a reduction in financial investors. Corporate VCs have maintained or even increased in some cases, but I'm talking sort of very generally across the sector. And if you have a look at the nature of the investors in our rounds, it ranges from people like LNG Capital, venture fund who came into Garrison, to some sort of specific venture vehicles, or indeed there's quite a lot of customer and corporate investment in the Oxa round, for example. So Mark, I don't know whether you wanted to add anything on whether you're seeing anything particularly unusual or different in your companies.
No, I wouldn't say so. I think what you said is a fair summary.
Thank you. Next question, perhaps I'll answer this one. Net cash has fallen by 42% over the last year. Do you expect the group to move into a net debt position over the next 2 years? And what sort of gearing do you guys comfortable? The answer I'd give to that is actually we're looking not to move into net debt generally. We're building our capital allocation models not to do so. Clearly, we plan forward 3 years. We are pretty conservative approach on that, and we've managed it well to date. We have the advantage, of course, we can always decide how much we invest into companies, which allows us to control our cash flow relatively well, actually. So the answer to that, no. As to gearing in general, we don't plan to gear any more than we are now. I can pretty much answer that question. About 10% of NAV feels comfortable to me. So if about 1.3, 1.4 of NAV, you can have about 140 million of debt. When that NAV grows, as it's quite likely to, if things like Isata and Isata and hopefully Oxa Nanopore, that might give the opportunity to slightly increase that gearing level. But I wouldn't personally, as a CFO, want to go above about 10%. I think the board agrees with that. Quite a good question. They're all good questions, but this is a good one, so I'm going to give it to you, Greg. Given IP discount, what are the main reasons you get from potential new investors on why they're not investing in IP? That's an answer.
Yeah, I mean, we're trying to make it as difficult as possible for them to give such reasons, but clearly people are still with trading at a discount. So I mean, one of the most common at the moment, and I'm using Berenberg data here, so I hope it's all right to do so, Odysseus. But one of the most common reasons is sort of it's not the market for these types of investments. Seems to be quite a common response to the position. So as you've seen, I've tried to give a bit of market context that shows that we think that the venture funding environment has improved somewhat. I mean, clearly quoted markets have had quite a run, particularly on the tech side in the US, albeit focused on a handful of companies. So I think it's so that does tend to be one. One is around we could make it clearer the success that we've had to date, the track record. So we're trying to build into our reporting more of the sort of typical VC type metrics. So things like we tend to try to quote the net return on NAV over the entire period, but as we move towards having the sectors in place for sort of 3, 4, 5 years, we'll be starting to disclose the IRRs of those sectors, and then of course we're doing the individual companies as well. So that can be one. And another one that we hear is it's quite a complicated story to get your head around, and so similarly, part of the logic for the strategy is to help to drive to greater value creation, but also to make the story easier to digest. That sort of simple investments with impact across those 3 themes, and with those 3 key value drivers is trying to get it sort of as simple as possible. So I think that's probably a few of the reasons that we get.
Yeah, I'm down to my last few questions. You'll be glad to go until the end. There's one that's a statement saying, I think you should continue not to do share buybacks. That's obviously an opinion. It's a thing that people debate about long and hard. How big a stake in IP Group is held by staff and directors? That's sort of fully disclosed in the documents.
Yeah, I mean, it's fair to say that we have a policy which I'm definitely building towards to have. I think it's 3.5 times my salary in IP Group shares. I continue to buy shares periodically. Half of my bonus is deferred into shares, and all of my long-term incentive is in the form of shares. So I'm very aligned behind having a shareholding and making sure the share price is as buoyant as it can be.
Yeah, and I think I'm in the same place. I might be only 3 times salary or something, but I'm very similar place. Quick FX question. You mentioned the loss attributable to FX. Do we ever attempt to hedge FX? I haven't normally had to hedge FX because we also had commitments as well. So it's kind of self-hedging traditionally, because we use dollars when we're investing in these other territories. We have, though, hedged in the case of, for example, an exit in the US, and we hedged some of that foreign currency risk. So it's mostly been self-hedging, and where it hasn't, we have done so. Is the answer to that? I think this is the last question. Given that IPG is a small cap category, does that mean you're excluded from the mandate of institutional capital? If so, how can you better attract more institutional capital to the shares? So last question, probably for you, Greg, after that one.
Yeah, great question, Nirav. I mean, for a relatively small cap company, we've got quite a blue chip share register. I mean, the share register at the half year is in the back of, I won't flip through the slides, but it's in the back of the presentation so that you can see. I mentioned earlier that we've got quite a number of institutions. I mean, one of the other challenges that we face a bit at the moment, and it is quite circular or self-fulfilling, is that because of the size of the market cap and because we've got quite a steady, sticky top sort of 10 or so shareholders, the proportion of our free float, which is liquid and therefore available to trade, means we've got quite an illiquid share price. It's not uncommon in the UK markets at the moment to see earlier comments on equity ownership, but we do bump up occasionally against people who have daily liquidity risk tolerance, who would like to have exposure to venture, sort of listed venture, for want of a better phrase. So one of the things we are mindful of is you might have seen there's a couple of other smaller vehicles doing similar to what we're doing. And generally speaking, when you get down below sort of 100 million or 200 million of market cap, it's very hard to escape from that. So scale of this vehicle is quite important, not to the detriment of performance by any stretch of the imagination. And in terms of how do we better attract institutional capital, clearly we go after the long-term pools. So pension funds, sovereign wealth funds, family offices, and particularly, as I mentioned earlier, the ESG and sort of impact-focused funds. We don't market ourselves as a sort of regulated impact stock, but clearly the underlying drivers of pretty much every company that we have in the portfolio is delivering genuine real-world impact. So that's how we position it with those holders.
I think we're going to call it perfect time. You're 1 minute past 11 by luck and good judgment. But and there's a couple of questions, not many, about 4 we haven't answered. We will make sure we do those offline, because specifically about companies or whatever. And I will just therefore hand back to Greg for the final comments.
Thank you. So I just wanted to very quickly, so I mentioned this at the start, and it points to this thing around, how do we make sure we're attractive to institutional capital holders, and indeed that we can help investors to understand what's in the portfolio and how we go about delivering value. So we have a very active program of events. You can see the 5 events that we've already completed this year. Hopefully the investor update with Gordon and Peter on the genomic space was good insight into that space. These half-year results we are doing virtually as always. We've got a deep tech event, we've got an ESG deep dive, ESG and impact deep dive, and we've got a clean tech event coming up this half, and we will probably be looking to redo our deep tech conference in Asia with our portfolio companies in the first half of next year. So very, very active in this space.
Greg, David, Mark, thank you for updating investors today and for addressing all those questions. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of IP Group PLC, we would like to thank you for attending today's presentation, and good morning to you all.